right. The Federal Reserve is expected to raise interest rates again today after pausing more than a year of rate hikes last month. Experts believe the central bank will increase rates by 1/4 of a percentage point as part of its ongoing fight against high inflation. The Bureau of Labor Statistics reported this month that the consumer prices dropped to 3% in June. That's still 1% above the Federal Reserve's target rate. CBS News business analyst Jill Schlesinger is joining me now, though, to talk about what this all means. We're doing it. Like, it's almost at 2%.
I know, but 2 to 3 is big. Great progress. Okay. 9.1% in the CPI index. That was the high June of 2022. And this is an annual increase, okay? Mm-hmm. Now we're down to 3. You say, yeah, let's get out the party.
Right.
Okay, but from 3 to 2 is going to be a lot harder. Couple of reasons why. Number one, the comparisons to a year ago are going to be harder, meaning that as the consumer price index has come down over time, when we look back a year later, it's going to be a little bit more difficult to get that movement. Also, we've seen great progress in energy. You know, we're not at $120 a barrel and $5 gas. That's come off, but we are now seeing a little resumption, a little bit of acceleration. So what the Fed is really trying to do is stake a claim here and say, we're not done on inflation. We're concerned. We'll go by another 1/4 of a percentage point because we believe the economy can absorb another 1/4 of a percentage point, and we still want to see that inflation rate continue to come down.
Okay, so then the question is, how will that impact me? Just a regular person.
Well, let me look at you specifically.
Okay.
So most of us have a real impact that we feel from the Federal Reserve. It seems like this esoteric thing in D.C. that happens, but most of us are either borrowers or savers. And when we borrow money, at least on a short-term basis, those rates will remain high. And even if the Fed stops, even if they say, okay, after this meeting, we look back and say that was the end of these rate hikes, they're going to keep the rates higher for longer than many people expect. That means borrowers are going to pay more in interest costs. It means even though the Fed does not control mortgage rates are going to stay high. So borrowers are contending with those higher costs. Savers, they're partying. They're partying like it has not been this great in a long time.
Right.
Because it's amazing. You can go online, you can find 5% rates on savings and CDs. And this is an amazing turn of events for people who just a few years ago were contending with 0% interest. So I think that this is a real impact that we could all feel. We're sort of getting used to it. The most important thing is that we realize when the Federal Reserve speaks, when we hear these officials talk, they are guessing about the next path forward. They don't know. They thought inflation would be temporary or transitory. It's lasted a lot longer than they thought. And when they say we think there's going to be another rate hike by the end of the year, maybe, but maybe not.
So I expect that, Wall Street won't react in a volatile manner because this was sort of predicted, and Wall Street sort of likes stability. When you said that the Fed thinks we can absorb another interest rate hike, does that have something to do with the fact that wages also keep going up? And wages are going up, inflation is slowly going down, and they're not meeting yet, but they're pretty close.
Well, I would say for people who are in the middle to lower income arena, that is really interesting because their wages went up much more than, say, the upper middle to the high. And so those wage gains are holding as inflation comes down. And we have actually flipped right now where median increases are exceeding the pace of inflation, which is great news. Think about this. Let's go back and we say, okay, if I was a worker in an Amazon warehouse and I was making 12 or 13 bucks an hour a few years ago, inflation was really low. But now inflation is higher, but I'm making 20 bucks an hour.
Right.
So life has actually improved for many people, not everyone, but many people on the lower end of the spectrum. The big areas that the Fed is concerned with when it comes to the labor market is they want to see job creation. They don't want to see wage gains go up by too much. That helps fuel inflation.
Right.
So when they think we can absorb it, they mean the labor market is strong enough. The economy continues to grow. We are not in a recession. All those people who said we're going to be in a recession in 2023, they're kind of erasing those predictions. Thank goodness for erasers. They're really psyched that they are seeing growth. And we are going tomorrow morning, we're going to get the first estimate of second quarter growth, GDP. That's going to show a plus sign. And we had 2% growth on an annualized basis in the first 3 months of the year.
Yeah.
The next 3 months, we're probably going to see maybe 1.5%, 1.8%. It will slow, but it's still growth, and we'll take growth.
I think that, I mean, I don't want to say soft landing because I don't want to jinx it, but okay.
But it's all right.
It's good. It's good. It's all good.
So far, so good.
Yes. Jill Schlesinger, thank you very much.
Sure.